You're listening to Real Investor Radio with Craig Fuhr and Jack BeVier, where we cover advanced real estate investing topics to help you stay ahead of the curve in your real estate investing business.
Hey, welcome back to Real Investor Radio. We've got a special one for you today. I'm Craig Fuhr, joined again by the greatest co-host ever, Jack BeVier, and we've got a very special guest today, back with us for this 100th episode, Jack. 100 episodes, can you believe it?
Nah, it's crazy. Can't believe how the time has flown, man.
Well, we thought we'd bring in the heaviest hitter of all, Mr. Fred Lewis, founder of Dominion, the Dominion Group, which also includes Dominion Properties, Dominion Financial. Jack, what else am I missing?
Dominion Properties, Dominion Financial, Dominion Management, our captive insurance company, Dominion Insurance. He's on the board of a DC bank. He's the co-GP of Sentinel Net Lease that's done about $250 million of net lease deals in the past 4 years. Fred keeps himself busy. I get that question a lot. Like, hey, what's Fred up to? Is he still in the business?
No.
And I just crack up. I'm like, yeah, he's still in the business. Yeah, he's working.
Well, I've had the pleasure of knowing both of you for many years, and I've also met many investors across the United States, and the two of you, to me, just represent the pinnacle of what the industry can be with a lot of hard work, a lot of time on task, and obviously now with a lot of great personnel to carry out your visions. I just think it's such a delight to have both of you on this 100th episode to be able to discuss a wide range of things, Jack. There's so many things that when I get you and Fred together that we talk about and that I learned from. And so today I thought it would be just a really great show to kick off our next 100, to have both of you on the show and then really just talk about some things. So I really want to talk about the trajectory of real estate investing since Fred got in 2002. And, I got in 2004, had some success and quite a bit of failure towards the end there after 2008 crash. But then really talk about how the industry hasn't changed. We still have to worry about, the main components of real estate investing, which are acquisition and marketing, disposition, finding great contractors, materials and labor, as well as the financing aspect of the business. And so I thought I would kick it off, Jack, with just a brief synopsis of what's going on in sort of the top 10 markets in the country right now, MSAs, if you will.
Well, first, I'd like to thank you guys for the intro and appreciate that. And it's always good being with you guys.
Fred, if you could only talk to when spoken to, that would be.
Sound like my wife. Thank you, Craig.
As I sit in the building that you and Jack own, I'm going to chastise the owner of the company now. No, honestly, Fred, it's always great. Always love when we can sit down and I can learn from you. And now our entire listening audience can, which by the way, Jack, I think we receive more comments than I think most people might know on how much the podcast means to them and how much they've been listening. I get guys that are like, I'm in the gym at 11 o'clock at night and your podcast is a must listen. I get guys that are like, whenever I'm in the car, the podcast is on. So it's really become must listen content with some of the great guests that we've had over the last 100 episodes, Jack. And I think if folks went back and really took a look at the guest list that we've assembled, it's really the top who's who in the industry, guys that are just have been around, lots of reps, and who are still out there killing it today.
Yeah, I mean, that was always our goal too, right? Like what we felt was the vacuum in the market was kind of like that higher level conversation about real estate investing content. There's no shortage of guys, on YouTube and on podcasts telling people how to get started and how to, break out of their job and using a lot of very surface level conversation to discuss strategies. But
standing by their rented plane and their rented Lamborghini.
Yeah, exactly. But we didn't see that higher level of conversation talking about like what the nuts and bolts, boots on the ground, good, bad, and ugly was of operating the business and full time, and at a higher level and trying to succeed at it and treating it as a business, not just as either a hobby or as a dream so that you can quit your job someday. And frankly, I think and we'll discuss, I'm sure, a lot today, the industry has matured a lot, and it's not good enough anymore to kind of half-ass it, right? Like, you're just not going to be competitive if you're winging it. And especially with what's happened over the course of the past 2 years, the wind is no longer at our backs as an industry. So all that tide is going out right now. And frankly, I think the timing is, couldn't have been better for the kind of content that we're putting out right now, because I think that, being on the cutting edge, being on the front edge of the curve with what's going on in the market and what's working and what's not, the stakes are higher today than they have been before. And I'm proud because I still don't think I've discovered content that is at the same level as we're talking about, and the quality of guests that we've been bringing on. So we're going to keep doing that, and I'm excited about that. That's the fun part too. So yeah, looking forward to the next 100.
Yeah, it's going to be great.
Great.
So guys, let's just set a backdrop of where we are in the country right now in terms of the market. I did some brief research on the top 10 declining MSAs in the country right now, and they are really no surprise here, but Tampa, Florida, Austin, Texas, Miami, Orlando, Dallas, San Francisco, Phoenix, Jacksonville, San Antonio, Atlanta, Georgia. And frankly, not small declines year over year. Tampa leads the list at about 6.5% down year over year in terms of median price, and Atlanta, Georgia would be the 10 at about 3.5%. Top,
Are those year-over-year numbers, by the way?
they're year over year numbers. That's correct.
Yeah,
And
I think it's worse than that, but yeah.
Yeah, and it might be in those MSAs, there could be sharper declines sort of regionally. Still hot MSAs would be, this is mind-blowing to me. Detroit, Michigan, Cleveland, Ohio, New Brunswick, New Jersey, Virginia Beach, Chicago, Illinois, Pittsburgh, PA, Kansas City, Baltimore, Jack, thanks to you and Fred still keeping the market hot, St. Louis, Missouri, and Nassau County, New York. I don't know if I would consider Nassau County an MSA, but, Detroit starting at 10% up year over year, and Baltimore, Maryland at 6.2, that's number 8 on the list. Nassau County at about 5.8%. What can we say about, let's just start there. Would you have considered that, would you have even considered that fact that those top markets would be increasing year over year, Jack and Fred? We're talking, East Coast, Rust Belt, type of markets, not these, smile states that everybody got hot and bothered with over the last several years. Why are we seeing that type of increase in these markets that we probably would not have considered?
I think what's interesting is in real estate, there are substantial material changes that occur that you can't see coming, that are based on changes in migration trends, overproduction, overinvestment. The history of real estate investing is always about something happens. There's a thesis, and where there could be a break in the market. There could be, for example, in Florida, we saw lots of migration. We saw a lot of people moving from the Northeast. It's a tax-free state for a lot of folks. There was a lot of, it was easier to build there. There was a bigger supply of contractors. So what happens is people start to oversupply, overinvest. And then other factors come in. There's storms all of a sudden. And now you have higher taxes, you have a change in some patterns. And the people who are there early tend to not only succeed perhaps, but also overemphasize the attributes of why they're there, and then don't prepare for a cyclical change in what may occur. And I think that's happened in Florida. And right now it's not, I don't think that Miami, Orlando, or parts of Florida are bad places to invest. I just think that there's been substantial overinvestment and oversupply recently.
Fred, how come, after what we saw in 2008, the GFC, and then in COVID, my wife and I were seriously considering about 2.5 years ago moving to St. Augustine, Florida. And so we went down and we took a look at not only there, but also on the West Coast where her folks live in Sarasota. And every development that we rolled into, yeah, we're building 10,000 houses here. Yeah, we're building 15,000 houses here. You know, it's a multi-phase plan, but that's 15,000 houses. Next one, 5,000 houses, 8,000 houses. And so the builders are pregnant. You know, they've got the land. They've got, you know, they've probably got permits. They're probably moving some dirt around. You know, why is it that they don't see the cyclicalness of making such huge commitments when not only them, but when all the other builders around them are doing the same? Is it a point where you're like, well, we bought the land and we're moving forward and this is what our investors expect us to do. But why does there never seem to be like
Well,
thought any thought into
there's
like,
a
hey man,
tremendous
we have to just slow this down a little bit?
there's a tremendous bias in historical information or previous information. You know, the assumptions you're making from the data that you're using from 6 months ago, a year ago, 2 years ago, there's a tremendous bias to lean in on that information
And believe it.
and to go with the herd. And it's a really interesting observation. If you think about just multifamily in general, or in 2001, 2 into 3, all these operators kept saying, I'm going to have rent growth of some crazy number. I'm going to have occupancy that's almost fully occupied. I have unsatiated demand. And at the height, you could see it coming. You could see that those assumptions, and people kept building into those assumptions. And in states like Florida and other states where they just thought there was an endless level of supply they could build. Now, fast forward only a few years, it's the opposite. The vacancy rate is much higher. Most multifamily operators are struggling. Rent growth is negative in most markets. So, you know, it's really about it's about being prepared for success, I think, and be prepared for failure at the same time. You have to be prepared for both. So if you are contemplating what it's going to be like to throw down on a new investment, you have to have, you know, as Jack alludes, a business operation that also could be prepared for what happens if that doesn't occur that way. Because otherwise, you're one investment away from complete failure.
Well, Jack,
Let me jump in. There's a I remember right when I started back in 2007, and then what happened the next couple of years, and
perfect
there
timing.
was perfect timing. Yeah, started in March of 2007. Just did workouts for 4 years, but the price decreases that we were seeing in those other markets, the ones that you're describing right now, right, and were much higher than the kind of the more boring markets that you just also said in terms of the ones that are succeeding right now. And so there was this like conversation at the time that like, hey, yeah, you know, those hot markets, you know, they boom, but then they also bust. And so like there's a higher beta, right, higher volatility to certain markets in the country. And those markets tend to be the places where you can get permits, right? Because you can get permits, you can supply the market very quickly. There is land there to build upon. They're lower tax environments. They actually want people to come live there. And so you have these bigger run-ups and it allows humans to frankly express their nature, right? Like, to me, this is like a fundamentally human problem that like there's something about humans in markets that we get irrationally exuberant on the upside, and then we have both greed and fear, right? And so we get irrationally exuberant on the upside, and then we just completely quit the market and starve it of liquidity on the downside when we're afraid. And as long as humans are wired the way that we are, that's going to happen. To me, it just so happens that in Arizona and Florida and Texas and Georgia, you can get permits, and it allows humans to behave. Whereas in the Northeast and the places that have regulated that out or have lands or don't have any more like land or don't have any more water, you know, they just restrict permits and restricts humans from acting. And those markets just sit, you know, at inflation, right? Boring. And you know, sometimes they have little ups and downs. but there's nothing special. But that list is the same. The two lists that you just described are the exact same two lists in 2009, right? And it just so happens that the first list is following this, is following a pattern that looks like this. And the second list is following a pattern that looks like this. So it just so happens that right now, those supply constrained markets in the Northeast and the judicial foreclosure states are, they're on a relative basis stronger than the other ones. But the markets that allow a lot of supply, because they experience bigger swings, those swings happen in both directions because humans, and so they're all experiencing the correction back right now. And so it'll be fun I think there's just going to be interesting opportunities in those markets as a result, because we'll watch humanity play itself out and overcorrect in the wrong direction. Whereas the Northeast markets are really have always been kind of cash flow markets, right? Like, why does any money go there at all? It's because the cash flow is a little bit better. And so they're more the boring cash flow markets, versus the high beta markets are the ones that attract investors because of the appreciation potential.
So no surprise for you then on those top markets that we just mentioned.
No, it's the same list as if you would put that list up in 2010, it'd have been like the same list, right? And then the opposite, right? Like, but the hot markets in 2006 were also the hot markets in 2015. And I think that that's just, I now, with the benefit of 18 years of watching it, like, I just think that that's just a function of human nature. That's how these things are going to be. Now, you have to run your business differently, right? Depending on which of those markets you're operating in, knowing what's going to kill you, and when to be greedy and when to be fearful, knowing what's going to kill you and where the money's going to be made. They're different playbooks, right? Like you're playing football with Tom Brady as a quarterback, where you got phenomenal defense. Like, you need to run a different playbook to succeed, but you can be successful in both. But trying to run the same playbook in both of those, you'll definitely screw that up. That will not be a recipe for success.
Thanks for bringing up football, Jack, after yesterday's lovely loss for the Ravens. That season is over, by the way. So let's talk about, Fred and Jack, sort of how the industry has changed. It's no longer a mom and pop industry. Fred, you were talking about this just before the show today, and how it's sort of still the same. I still believe, guys, that it's a three-legged stool. You have to have great acquisitions and great marketing to find those sellers. Some way to get great deals. You have to have great contracting. You have to have a real pulse on better labor and how you're going to find materials at a decent price. And you have to have great capital, equity and debt. But that's changed dramatically. And I think both of you feel like, with the advent of some technology coming down the pike, that it could be a real benefit to better real estate investors who lean into better technology. Fred, why don't you start us off of, you've been doing this since 2002, and what was it like then, and how is it the same today?
I mean, I'll start with how is it the same today. I think the local hustle is still the same. I think the local real estate investor who works hard and leans in on a strategy that works, and different strategies work at different times, and certain strategies stop working and you got to pivot. But those that hustle understand their markets, understand what side of the street they're on, and then how to apply operationally the right capital, the right contractors, the right management, the right renovation plan, to that house on that side of the street, and then perform and execute, is still the same. All of that is still essentially the same. What's really different is just there was no national industry 20 years ago. It was 100% local. So from a standpoint of the national investors in real estate who buy in big markets and in some key submarkets today, the national players, and even the regional guys who may be in Houston and then go up to Dallas, or Dallas goes to San Antonio, or people in Georgia go in various markets and into Florida. I think that has changed to some degree. And then, of course, the capital markets has changed dramatically. You used to have to fight in your local market to get capital from your local bank. So if you're in, Savannah, Georgia, hopefully there was a little bank in Savannah that you could go have lunch with that would give you a loan to hold some real estate if you
Or
wanted
a
to put
hard
them out.
money guy, that was like hyper local.
Yeah. Or a local private lender, to give you a bridge loan. And in those markets, that has changed in that information and an understanding of the product nationally with some leaders that have helped create a national market, that has occurred. So now there are national private lenders like Dominion Financial and others that can play in a lot of markets. And I think it's democratized capital in a way that just never existed before. So
Yeah, just
the good thing is if you're an operator and you're disciplined and you're holding real estate for the longer term, you have you have access to capital that you wouldn't have had before early on. The negative to that is everyone has access to capital. And that's not always a good thing because now you're competing against some of the dumb money in certain markets that probably bid up something that you shouldn't buy. It really depends on what side of the street you're on. And you don't want to, so that could be a good thing or a bad thing. But I think what's interesting, probably the most interesting, is investing has always changed. That is the focus, is that the whole idea of being an investor is finding the edge, finding the reason, finding the game that will make you money in what you're buying. And then thinking about it as not just a transaction, but how do you leverage that for the long term? And so when I got in the business in 2002, the market had always kind of been a good old boys club.
Yeah.
It was just good old boys in the market. They did it a certain way. Their dad had done it a certain way. They had acquired inventory. There was a immigrant class that inventory was created to supply that class back in the 80s and 90s, and actually earlier, the 50s and 60s and 70s, when a lot of this inventory was built. And that inventory was being turned over. Because it was being turned over, a lot of those folks moved to the suburbs, expansion of the highway system and the economy. And a lot of that inventory turned to investors. And as that inventory turned, that was really the first big wave of investment real estate in the country. And a lot of folks, it wasn't really about supply. It was about just getting the inventory, doing the minimum possible for a lot of investors, and just trying to.
And it was a lot of the stock, Fred, was that sort of like inner city stock, and then just sort of on the edges of the city in the better sort of neighborhoods.
Yeah, whether it was
and
Baltimore row homes or St. Louis, lower
Philly.
in housing in the inner city, or, in markets all around the country, frankly. Not the new markets. It wasn't Orlando. It wasn't parts of Georgia, but it was a lot of markets. That's how things turned. And then folks in our generation started to get into real estate. And I saw the opportunity, not as just trying to own old inventory, but how to prepare that inventory for a customer. How does my customer, being the tenant, whether it's a Section 8 tenant, whether it's a lower income tenant, you want them to live in the house, stay in the house, like the house, because that's what makes you cash flow over a long period of time is how you make money, not cash flow over a short period of time. Turnover costs and other transactional costs will kill you. So I looked at it that way. And I think a lot of folks starting my generation started to look at it that way. And then that gets you into construction and product, and it becomes a very different investment. So I think what's changed is just how ubiquitous capital is, information, technology, the ability to access a strategy, but realizing that it's always about the edge. It's always about understanding some strategy that you're focused on, and that you're always, Jack, I've always said this since you've known me, you're always on the clock. It is a theme that I always believe in. No matter what you're doing that's successful, it won't be successful forever. So you're on the clock. And so there's only a short period of time that you will win at that strategy. So being prepared for success is as important as being prepared for failures and problems and issues and loss mitigation and risk. You got to be prepared, because you only will be successful for a period of time until it pivots. And then you got to go lean in on something else.
I think that is like an incredibly important point, and kind of like the thing that like I think that we've always focused on and done very well at is, and what differentiates a professional real estate investor who's building a business and who's going to make it through multiple cycles versus the newbie who learns on TikTok or Instagram or YouTube or Facebook what's working at that moment, right? Like the hype guy gets on Facebook and is just like, I just cashed $100,000 check doing this thing. And there's a little bit of truth to that, right? Like he's not completely a charlatan. He's just figured out the thing that's working right now. And then he gets out there and says, hey, everybody, here's what's working. Here's how you make money in real estate. And he's right for about 12 to 18 months until the market normalizes and everybody figures that out and closes that gap and gets rid of that angle. And they never zoom out and like, like get back up to 300,000 feet and talk about like what the dynamics are in all of these various different markets that is creating that little formula for that moment, and how, and then watching the trends to be able to figure out 6 months ahead of everybody else what the next one's going to be. Because it takes at least 6 months to retool even a very competent organization to where the ball, where the puck's going, right? And I think we've done a good job of being like, hey, we're making money doing this right now, but the conditions are changing, and here's what's going to be the formula next, and moving resources towards that, and then being there for a year, and then moving resources to the next one, and then being there for a year. And that has been like our history. Like that is our lives, is just like trying to figure out where the puck's going and then move the organization to that, and then move the organization to the next one, and then move the organization to the next one.
Can you guys,
you can't do that unless you're zoomed out a little bit or take time to zoom out.
Yeah.
can you guys think of maybe an example or two where you were, as my dad used to say, a fat hog in the, like really killing it with a strategy, and then but you maybe weren't looking to see where the puck was going and maybe got caught off guard?
Where we got caught off guard. So I'll say that. I'll zoom way back. For a long time before Wall Street got into the single family asset class, right back in 2009-10, where the debate was, is single family even an asset class? Like that was literally what people were paying to go to conferences and hear panelists talk about. Was like, is this a trade or a business? And we were always firmly on the business side, obviously, because we were already in the business. But the before Wall Street got in that, the way that you were able to add rental properties is the capital supplier for long-term debt was local banks, right? So you had to play the game a certain way, because the guy who was giving you the long-term money needed you to check certain boxes, right? So we had to balance how many rental properties we could add, how many refis. It was really a function of how many refis you could get. And we had to do a certain number of income producing activities in order to qualify for those refinances. And so that allowed that forced us to run the business in a certain way. When what we didn't see was exactly how the capital markets were going to evolve. So we went into Atlanta in 2011, bought a bunch of houses, wish we could have kept everything as a rental property. But frankly, we just didn't, at the time, the capital markets that for long-term debt were significantly affected. And we weren't from Atlanta. So we couldn't get anybody to lend this Baltimore company properties to buy houses they were buying in Atlanta. Except Wall Street came in with a debt product that we didn't take, because at the time it was like you could sell the property at 6% cap rate, or you could refinance at 7%. And we were like, well, this is easy. Like I took finance 101. Like I'm a seller, in that environment. And so we sold a bunch of houses in Atlanta. And then fast forward to 3 years later, rents had gone up a bunch, and we didn't see that coming. We didn't see that market stabilizing like that. So we missed that one, and we sold early. But also the debt markets had come down to the point where we could have, we should have kept those in our rental portfolio. So we didn't nail how the New York capital markets were going to evolve. And it wasn't really until the DSCR product hit the street right? It was CoreVest, B2R, and First Key. We talked about this in our first episode, Greg. CoreVest, B2R, and First Key were the first guys doing securitized debt back in like 2013, 14, 15 timeframe. And everyone was thinking it's going to be a CMBS product because that was the closest adjacent vertical for the New York guys to get their heads around. And so they were trying to treat it like a CMBS product. And it wasn't until Verus 16, 17 started to treat it like an RMBS product and created a non-QM, non-qualified mortgage product called the DSCR loan. That was what Main Street actually wanted, right? It was for 13, 14, 15, 16, Wall Street was shoving a CMBS product down Main Street's throat, and we all just didn't want it. And they thought we were, short-sighted, and we were like, you don't understand the Main Street business. And then Verus figured it out. They're like, these are Main Street guys. Like, give them a product that's simple, that they can understand. And they created the DSCR product, and it has been a smashing success from a capital markets perspective.
Total game changer.
So we did see that, though. We adjusted it when the DSCR product came out. We were like, oh, yeah, this is it. Like, this is what's going to work. And then we just shoved all in on that in terms of adding it, in terms of actually being like, hey, we need to actually originate this stuff. Like, hell yeah, we're going to borrow. Hell yeah, we're going to borrow that money. But this is going to be so popular that we're going to originate it also. We just figured that out. We never done long-term loans before. So that's kind of both examples for you.
That's a great one. Fred, anything to add there?
I would just add, there are obvious disruptions in real estate. The crisis in 07 through 09 was a clear disruption. There's different things that happen that are not quite a disruption, but a material change. And I think that recognizing that that's what that is, it's a material change in a market or a disruption that you have to, or a fundamental shift, like Jack's example of DCR. There's a fundamental shift in how the whole industry was financed. So there are moments in those changes or disruptions where you have to think about how prepared are you. I was talking to Jack the other day about the yield curve and where the 5 years been, because a lot of the DSCR product is priced mostly off the 5-year treasury. And the 5-year treasury, although it goes up and down, has been trending really closer to where it was last October, a year ago, where DSCR rates dropped into the low 6s, and you could buy it down even below that. And being prepared for an increase in opportunity volume, investors all of a sudden click on that. Now my rental properties cover more, or they cover. So guys like us need to be prepared with loan processors, customer service people to service when that phone rings. And so that's a really important thing. And that goes for any investor, whether they're in an adjacent market or in a market where they think they can take advantage of a change. Realizing that things will normalize or change again. So again, the theory of being on the clock, we've made most of the real successes Dominion's made is being prepared, making that educated decision to go all in on something or go mostly in on something, and having the level of preparation and thesis already outlined.
Jack, I still love to think about guys in the business and gals in the business, that some of who we've interviewed who have learned to scale, but maybe, they haven't been doing it for so long. So question one is it still a business where a guy can work a full-time job and do several transactions a year, be competitive, put out a great product? Or has it evolved so much that like the small guy just gets cut out? Like, if I'm working my full-time job, Jack, and I want to do several transactions a year, I've got to beat guys like you and Fred to the punch with my offer. And I've got to go out and find great labor, and I've got to go out and, do the marketing to find the deals and the financing and all of that. So speak to that. Speak to the guy who's maybe doing several transactions a year, has hopes of quitting the job and wants to scale up the size, let's say. Is it still a viable business for guys like that?
Well, I'd say like certain aspects have gotten harder and certain have gotten easier. So like acquisitions has gotten harder because the market's gotten more liquid. there's more, frankly, just more people in the industry still. And it's become, there's just more sophistication today in the market than there was 15 years ago, like period, like no question. So finding the deal has definitely gotten harder. I'd say getting the money has gotten a lot easier. And so the relative advantage of having a W-2 has gone down, right? Like back in 2008, 9, like you might only be the only guys able to get financing back then were because they had a W-2 income. Whereas today, the bridge money and the long-term money just doesn't really care about that. Is focused on other risk factors. And so I'd say that has become the capital inefficiency has become a relatively lower competitive advantage for those folks. And then but then I would say probably the construction and property management has gotten easier. Those barriers to entry have come down. Whereas before, back 15 years ago, you had to be paying guys on Friday. So you needed to like get there on Friday to like pay them. You've got more sophistication now. You can ACH, you can do stuff more stuff via technology, site visits with photos that are easier now. And the property management infrastructure also has it's not as if property, I think there's still a long ways to go in terms of like great property management. That market's continuing to get better at their jobs. But it's a hell of a lot better than it was 15 years ago, where for us, third-party management was like not even an option. Like it was like, no, of course we're starting a property management company because otherwise we're just throwing money down the drain.
You feel like there's a great property manager in every market if you just got to go out and find them?
I think that there are good property. There's a couple good ones in each market, which is a hell of a lot more than there were 15 years ago. That's my perspective on that. Yeah.
So how are you, given where we are in the market today, when you and Fred sit down and talk about what could happen in the next 12 to 18 months and where you might have to pivot the businesses, what are you talking about now? Like what's on your radar for things to look out for and to pivot to, that we could give some advice to the listeners on? What do you think?
Well, yeah, so the things that stay the same, right? Like the humans are still humans and they're still going to behave, we think, in the same way. And also towards the end of what stays the same is what can kill you is still the same, in that what can kill you is over leverage. And the humans are still going to over lever. Like that's what they do. And we're in that up cycle right now. And maybe we think we're kind of in that top end of the curve right now where things are flattening out and cracks are starting to show because the humans have over levered, and it takes some time for them to give up. But we're in that process of people giving up and it being really hard, and them, deciding that they're not happy and wanting to make other decisions with their life and tossing some keys or just failing for cash flow reasons. All the run up in those social media guys teaching people what worked at that moment, and what worked at that moment was money is easy. That led to humans taking a lot of money that they shouldn't have taken. And I credit Fred with the Fred's my mentor. I started with Fred when I was 23. I didn't know. So like Fred taught me everything. And philosophically, one of the things that I credit him with the most, that we survived the Great Recession, was his discipline with respect to not over levering. Like we would only take out our soft costs on refis. And it was not max out every refi for cash flow. It was, we were always talking about how do we delever? Let's make sure that the rental portfolio cash flows. And at the time, I didn't realize how unique that was. In retrospect, I do. And that was frankly the reason we made it through. Without that, we definitely would have failed. So I don't think that that's a lesson that most have learned still. And we see evidence of it every day in terms of DSCR deals that we're turning away for people over levering, and they're just not thinking forward. And that chicken's going to come home to roost. And we think that there's going to be opportunity in the wake of that in that set of mistakes. So I think that that's the one that we're talking about right now the most, is in terms of like what's going to be a driver of the next phase. Is that.
Fred?
Well, I mean, I do think it's interesting. I think there's a greed bias kind of way to think about it, where rents are going up, prices continue to escalate. Why? Lots of reasons. Cost of funds are continuing to go down as they went down in 2000, 2001. As the cost of funds went down and rents went up, you had a COVID, post-COVID, set of factors that drove some real estate attributes. But basically the environment created this risk bias, this greed bias, so that other investors start coming in because they're thinking about, I can make money doing that too, or I'm going to lean in and do more of that. And you're over leveraging, you're overbuying. And there are times in markets where the best thing to do is to be educated, learn from what's going on around you, and not to buy something. Sometimes that's a good thing. But be prepared for when the cracks do exist. You make money in real estate on the cracks, typically. Not typically because the herd has already moved that direction and you decide to hook your wagon to the herd. That's not usually where you make any money. That's usually where you end up getting slaughtered when the herd hits the hunters. And I think that's the issue. And for me, it's always been, how can we find the cracks? How can we find ways to make money in those periods? But be disciplined. And I think having a level of discipline in your business so that you don't make a bunch of money on one thing and then go buy the fancy car. For the listeners, never do that, because the assumption is that the next transaction will be just like it, or you're in the business for your ego. There shouldn't be any ego in real estate investing. If you make money on a transaction, it's not because you were smarter that day than the day before. And if you think you're smarter, then you're going to get killed, because it's going to force you emotionally to make a move that you'll get killed in because you thought you're smarter all of a sudden. I think the best way to think of it is be thrilled that you found the strategy, you found the game, the edge, and then invest it in your business, invest it in yourself. It's really, if anything's about the long term, it's about that. And that's really what's helped us through good times and tougher times, where we've had the capital to sustain because we didn't go on the edge like a lot of other investors. It's amazing. We see that even today. We see people in the industry go down that we know, and the story ends up being they borrowed all the money. They just assumed rents would continue to go up, or their outsale market, their dispo side would continue to hit the same numbers. And then in the last 18 months, that changed. And think about if you run a business where a reasonable change puts you out, then you're running a really bad business.
I think you guys have both mentioned some of the cracks that we're seeing in the market. And I want to get back to the capital side and Wall Street's appetite for single family residential. Do you see any changes currently, Jack, in some of the guidelines that we're seeing from the DSCR side? Is that box tightening, or is it getting bigger for DSCR refis? And let's play out a scenario where we could see a more than significant downturn in the next 12 to 18 months in the economy. What does that look like from a Wall Street appetite side for more DSCR financing? Or frankly, just for, single family residential?
We don't see any changes to the DSCR guidelines happening right now. When you look at the non-QM mortgage products and the relative delinquency rates of each of those products, DSCR is one of the best performers. Yeah, still. All delinquency rates are up a little bit, but also if you look at credit card debt and automotive debt, that's up significantly also. I was reading this article the other day about automotive debt and how those delinquency rates have risen, and how sometimes 6 to 9 months later, mortgage delinquencies start to uptick also. Not always, though. There are some reasons to think that this time might be okay and that won't happen this time. I'm kind of hedged on the idea. It's a wait and see and watch the data. But we haven't seen DSCR programs tightening up. What we have seen is DSCR loan purchasers more acutely focused on the risk management practices of their originators, of their counterparties, of the guys actually press and send on the wire. And so I think we're seeing a reset right now from a period from 2021 to 2020, early 2025, when risk management was deprioritized, was definitely not prioritized.
Just go out there,
and sales
rip the
was all that
loan.
mattered.
Yeah.
Yeah, exactly. Check all the boxes, send the wire. Check all the boxes, send the wire. And we're seeing a reset in that, or maybe a swing in the other direction from the strength of the risk management team. And a lot of originators are scrambling to build risk management teams because that was just never part of the recipe for success before. And also bear in mind, we're talking about a product that's less than 5 years old, or that's only 5 years old. It's really 5 years old now from a adoption perspective. So anyway, no one's seen a cycle through this stuff yet. And so I think that's what we're seeing on the DSCR side. I'm less concerned as to like whether, I guess, it depends on what the 5-year does and what the delinquency rates do. Like, does a consumer recession cause DSCR loans that were originated at 70% loan to value to default? I don't know. There's an argument that would make, the prevalence of renters stronger, and I'm not certain that I think that that's going to be the product that's affected by a recession. So I can't quite draw that direct connection in my mind as to why that'll be the product that gets affected by it.
I'm glad to hear it.
So
Fred?
less concerned.
Well, I think my viewpoint is standards will change a little based on the people who behave poorly. And there are people who use the product who intend to behave poorly from the very start. I'm a glass half empty guy when it comes to people in general, because
Mr.
I think
Optimist.
people there's always that 5 or 10% of people who are looking for not just an angle, but are looking to steal from somebody else. And so if you are, or just it's an opportunity to take something. So if you have a property that gets appraised for $200,000 on the market that's worth 120, or 400 is maybe the better example. It's really worth 300. Like, I don't know how the hell I got that appraisal, but I'm going to go take all the money, and it doesn't really cover, but I'm going to do that anyway. And I'm going to keep collecting as long as I can. And the minute I get a vacancy and I got turnover expenses, the bank bought the property. Like that thread is real, and it's just a function of behavior. And that behavior does exist. I think that as DSCR product got launched, the industry, once they were sold on it, they also deluded themselves that everyone taking the product would act the same. Every investor with good intention is, why would they not? Why they want to buy and hold. And this is an important property for their retirement and for their family. And they personally guarantee the benefit. So those are back of the envelope, sitting in a boardroom assumptions that make total sense. But then humans behave. And so there'll be outliers. It may be 5%. I don't know what it's going to be. I mean, it's already happening, but that 2 and 3 and 4 and 5% of that behavior can kill a pool depending on how bad they behave. So I think there'll be some adjustment trying to dissect and understand that behavior. And then there'll be overlays to that behavior. I'm just hoping that those overlays don't get exaggerated or don't get overdone so that it hurts, a certain market or a certain type of person. But I think there will be adjustment in the product.
I just think that I'm probably glass quarter full when I think of sort of the pool of investors across the United States. And I think that you and Fred, Jack, have become exceptional at what you do. But I think we live in a market where there's not, that you guys are truly the exception as operators, and that there's a lot of folks out there that are utilizing the DSCR loan, but aren't really looking around all the corners.
Yeah, they don't know their own math, right? They believe when they get a 1.2 DSCR loan that it covers 1.2, right? Which is, to me, 7th grade math, that it doesn't, and everyone knows that. But if you just never wanted to know and learned this off of YouTube, then maybe you think it does,
Yeah.
Well, as an example, Craig, someone will call and they'll ask, "Hey, I see the product. I can borrow 70, maybe up to 75 of the appraised value, and it covers at 1.2, but it's really more like a 1.0. hey, but do you have an 85? Do you have an 85? And I heard that there's a 0.9 out there in coverage. So I can literally borrow money for, I'm going to borrow all the money, basically. The property won't cover at all. And do you have that? Because I want that. Oh, and that's an extra point in
rate. Yeah.
rate. And I'm
I'm
going to
willing to
pay,
pay that.
instead of 6 point whatever, I'm going to pay 7 point or 8% for that product. Think about the mentality of that human and that it's not an investor. That's what we need to understand. That's what we need to really illustrate here is there's true investing. And then there's someone seeking a trade for some human behavior that really isn't investing. And the speculation of that means that you better hope that real estate that you just refinance goes up in value some way, somehow, in a market that we're seeing declining values.
Yeah, and it's not anymore. And it's not in the past 9 months. And the math that you were just talking about, Craig, is the data very recently, but that's also the year-over-year data. When you look at the month-over-month data, it's worse. Like you annualize the current month-over-month price decreases in the market right now, and we're going into the winter where the seasonally, the seasonal adjustments, when you get rid of the seasonal adjustments, that's not a thing, right? Like in reality, the winter's awful. that's the reality is from a cash flow perspective, December sucks. And values are even worse. And so like you're not making money flipping, or you're getting squeezed in flipping. If you're a real estate agent and you're making commissions, that shit's hard right now. And you quit your W-2 because you cashed out a bunch of refi proceeds and pulled in more cash than you'd ever seen in your adult life. And now you're going into this winter. I'm super skeptical. I think that it's going to be a long one. Yeah. So anyway, sorry, go ahead.
So there's a new product that was being launched this early in the year, late last year, which was a close-in second product. And the idea of, and it became like a buzz thing in the whole industry, which is, oh, there's buyers now, just like they buy DSCR and they aggregate it and send it into Wall Street, into a bond, doing the same thing for the second product.
Explain quickly though, Fred, how a close-end second on an investment property works.
So if you own a rental property, let's say you did a DSCR loan 3 years ago, and you believe that the appraised value today is much higher, therefore you have equity in it. Not to suspend the coverage comment, because it may not cover a whole lot more. Maybe your rents went up a little bit since you financed it. On a reappraise, it may come in that your existing loans are around 60% or even maybe 50% of that new appraised value. So what a close-in second is, it's just a specific second lien product. They'll go from 50 or 60% back up to 70 or 75 or 80, depending on what you're able to get. We'll call it 75. So that junior part of the capital stack there, you can get a loan. Now that loan will be much more expensive. It won't be the 6-7% loan. It'll be the 8-9% loan, or maybe even a 10% loan.
It's 9-10.
So, but the argument that one makes is, but I got all this equity that I want to unlock. Like this idea that I want to unlock this equity that's sitting there not earning me money, so that I can take it and go buy another piece of real estate and then try to borrow 85% of that. Like that mentality is wrought for destruction. And that's what I think, that's just a moral hazard. Jack and I looked at the product. It was a high commission product. It was a high margin product if we were to issue it as Dominion. And we just couldn't get over the moral hazard of it.
Yeah, we discussed it very briefly at lunch one day, Fred, and I was kind of trying to wrap my head around it as well. If I'm borrowing 10% for the remaining equity that I have in a house, what's my business model on going out in this market right now and making above 10%?
Yeah,
I guess
hard.
on maybe some flips, but like on another rental, am I making 10%, over 10% on that money? Is that am I thinking wrong there, or?
Well, here's the thing. The fact that a lender is willing to lend it because they're the ones making earning the 10%, and they feel there's enough equity inside the real estate to lend it to you. So they're making their decision based on the validity of the appraisal.
Yeah.
And that they'll just take your equity if you don't pay them. And that doesn't mean you take the loan. It actually means you probably should reconsider taking that loan.
Which, by the way, all of this is not to say that we think that that's definitely going to fail in all situations. We just think it's just above our risk tolerance in terms of the transactions that we want to be involved in. Like it's just not for us. Like, is everyone going to fail there? No, but enough people are going to fail that we just, you know what, that's not the way we want to make money. In our opinion, and we're also guessing, right, as to how many people are going to fail. But we think that enough people are going to fail that it's like just business we should stay away from.
Getting back to my point of Wall Street's appetite for single family, not only housing from a purchase standpoint, Wall Street, but from a financing standpoint, I still think that there, in any sort of downturn, when the keys start coming back, I think that the DSCR envelope is going to close very quickly. Like the guidelines will be, like enough bad actors will change that product precipitously. And I think it would happen very quickly as well. It won't be a gradual thing. But that we always like predictions on the show, Fred. So that's my prediction. Recession, a little geopolitical event, anything that could happen to like make people foreclose on these loans. Like look, I think that we do great loans here at Dominion. We underwrite great. We check appraisals. We do really great DSCR loans by and large. But as a loan officer with the company, I talk to a lot of investors, and frankly, I'm just going to lay it out there. If you're listening, I'm sorry. I think that there's bad deals. When I'm looking at this is the guy's mortgage, PITI every month, and this is his rents. He's making $250 a month cash flow. How many of those do you have to own that go vacant before you start giving back keys? And I just think that there's a lot of guys out there in the market right now that have those loans.
Well, I mean, I certainly think there will be some of that for sure. To the scale what occurs, it's a wait and see. But
yeah,
I think that again, back to bad behavior. I think there's enough bad behavior in markets where, for those that take all the money, they're playing the game at the edge. Is really my point. Some of those will bear out fine because they'll just work it really hard when something bad happens. And then there's investors that don't know how to grind or don't know how to deal with conflict or don't know how to deal with their problem. If you renovate a property well enough and you have a decent enough tenant and you execute on the real estate side, again, just fundamentals of real estate investing, and you happen to over leverage, it's not a death sentence. It just means that you're more on the edge. And to the extent you're on the edge, if there's other factors that you're alluding to, which is the vacancy, the maintenance cost, the turnover costs become high, and you didn't execute well enough across the board, then yeah, those guys are going to likely fail.
Let me play devil's advocate, just because everyone agreeing with each other is no fun. The argument against is that they're gonna turn it over and put it on the market into a supply constrained environment. And then the question is, did you get the appraisal right? And if it was a 75 or 70% loan to value loan, then they can get out and keep their personal guarantee and their FICO intact. And there's enough equity there, right? Like, these DSCR loans are being done at 70, 65, 70, 75% loan to value. The conventional resi market is like 80, 80, 90, 95, FHA 96.5. Like, there's a lot more equity in this mortgage product than everything else it's being compared to. And that is the reason that Wall Street is telling itself right now as to why performance is better, is that yes, guys get themselves upside down operationally. They just screw up. Life happens. But then they sell it, and they sell it and they get out because we only lend at 75%. And there's enough room to pay commissions and closing costs and turn the thing over and keep the guys and not keep the guys' FICO intact.
Yeah, but who does all that inventory go to, Jack? Are you and Fred going to go out and buy houses at the courthouse steps at 75% of appraised value?
No, it goes back to those first-time home buyers that got boxed out by these these bad investors in the first place, right? These investors in the first place that were gobbling up inventory and creating the shortage in the first place, And so all that story is very cohesive, right? Like, oh, the bad investors are cycling out and the first-time home buyers will have a new opportunity again. And then Trump's putting pressure, as of this morning, on Fannie and Freddie to do something about affordability. PIMCO's arguing that that we should be buying MBS again to stabilize the housing market because it's good for policy and also super self-serving for PIMCO, of course.
Just a little bit.
But everything could be fine. Like there is a case that everything's going to be fine. So
let me play devil's advocate to devil's advocate.
Let's go.
I think it's about execution purely. I think it's to the investor who renovated the property fairly well or bought something that was in newer condition that they updated. You have a much higher likelihood of achieving on a vacancy a homeowner sale. To the extent that the real estate doesn't look anything like what a homeowner product needs to be, and they got a relatively high appraisal, I think that becomes an issue.
Yeah, but both of those, in my opinion, by the way, I would argue though that both of those are V issues. Both if the appraiser both chose the wrong comps and was comparing apples and oranges, well, Jesus, yeah. Well, then the appraisal is screwed, and those are going to be your delinquencies. Yes,
right. But I think the point being is what's really great about single family real estate investing is there tends to be, and there's always has been, multiple exit opportunities. There's optionality in a lot of what we do. And a lot of what we think about when we buy real estate is, what does that optionality look like? We can rent it, we can sell it. There's different things you can do to exit and to invest in it. And I think understanding those two are really important. So, hey, that investor who's going to over leverage, maybe his point is, yeah, but I'm still inside of what homeowner pricing is. I can always sell to a homeowner. So that may be a thing. But I'm one that doesn't think that doom and gloom is coming. I think that there'll be adjustments around behavior, but I just don't see a fundamental change in investment in investment values. I think they'll just be. I think we're in a period of rents have stopped. They're not growing. They're receding in certain markets. Vacancy rates are higher in certain markets. V has started to kind of stabilize or actually recede a little bit here and there. I think all that's great because all those cracks in different places only provide new rounds of value. Investors who want to, find the edge there or find the opportunity. But you can always make money in real estate investing if you can directionally take a bet and that direction is reasonably valid. I just don't see a direction where we're going to see substantial declines, generally speaking, in investment real estate.
You would
not our investment, not single family.
I'd argue that the what's coming next is going to be I have a hard time understanding how it's not going to be a better time to buy over the course of the next 24 months than it has been over the last 24 months. I think that there's going to be, all of this leads to, we can argue about the relative scale of how much disruption there's going to be. But I think just, you'd have a hard time convincing me that there's not going to be some investors who fail and some investors who have cash flow issues as a result of this stuff. And as a result, there's going to be fewer bids on that property, fewer people at the auction, fewer people sending direct mail looking to buy houses, fewer customers for the wholesalers that are sitting across the kitchen table trying to buy houses. And as a result, the investment real estate prices, even if the top line doesn't move, right? Even if ARV does not change, the investment number is going to come down because all of the investors have headwinds right now. And so you should see it. You should see increasing spreads, increasing margins, better coverage.
Your argument is an increase in spread and margin. I actually do buy into that. I think that if you ask me, there's a list of things that can trouble an investor in the world of execution, whether it's the real estate itself, the side of the street, the location, the renovation, all those things are really critically important. I think liquidity and cash flow is the number one.
Yes.
I think that is going to have the most impact in the investment markets over the next year or so. And I think that is, I agree with the point that then leads into fewer dumb money buyers or just buyers in general in various markets. Certainly there'll always be new entrants, but I think that is the driver.
Craig, just one of the things I was just thinking of, like the data that you launched us off with in terms of the Baltimore was one of the better performing markets, and it had seen something that was 6% home price appreciation year over year. I will take the under on that number all day. That the problem with this reported real estate data is it's always 3 months lagging. They almost always report it year over year, which is completely irrelevant. Like that's just not, the market moves slow, but not that slow. Like it should be what's last month's, but it's also, it's hard to do last month's same store math, right? Like that is mathematically very difficult to do. So I understand why, but just, which is why then people, argue that like, hey, the local anecdotal evidence like is really necessary in order to operate within a market. And if you're just looking at charts all day and trying to invest in, from out of town, you're gonna be behind the curve, like always. And I do subscribe to that. But I just feel very confident, even in the Baltimore market, which is on the top 10 list, is down actually right now.
Really?
Than it was, yeah, in the past 3 months. I think it's down since November. It's definitely down over the course of the past 120 days, and every month is getting a little bit worse. But for that, we had like a 2-week period 30 days ago when interest rates got a little bit better for a minute. There was a shot of contracts, and then it just died again. So like the market is uber sensitive to mortgage rate. Like the homeowner market right now is uber sensitive to homeowner to mortgage rates right now. And I think it's a reason that the Trump administration is now taking aim at Fannie and Freddie and trying to pressure them into doing something to lower mortgage rates, because that's where that'll be good politically. But I also think that is a very effective lever right now for the real estate market is mortgage rates. If we put a 5 handle on them, everything would be fine. Is there fundamentals though for there to be a 5 handle on mortgage rates? I don't think so. Like I don't actually personally think that the mortgage rates are mispriced right now. So hey, if the government comes in and subsidizes the market somewhat in some way, we'll certainly keep an eye out for that, and maybe that bails out this whole freaking conversation. Planning our business based off of like what we think rates should be. And I don't see any reason for this, for this status quo to change other than from some kind of government intervention.